the Do-Over Trust. My name is Matt Blattmacher, Vice President and Trust Officer of Peak Trust Company, formerly Alaska Trust Company. Before we get started, I'd like to take care of a few housekeeping items. Today's presentation is being recorded, and we will provide both the recording and the slides to all attendees. On the right-hand side of your screen, you may enter any questions you have into the GoToWebinar panel, and we will address as many as we can at the end of the presentation. Now for our presenter. Today, we are very fortunate to have Steve Oceans with us. Steve is a member of the law offices of Oceans and Associates, located in Las Vegas, Nevada. He is listed in the Best Lawyers of America and was named the Las Vegas Trust and Estates Lawyer of the Year in 2012 and 2015. He was inducted into the NAEPC Estate Planning Hall of Fame in 2011 and has been named one of the 24 elite estate planning attorneys in America. Now, I'd like to turn things over to Steve.
Thank you very much, Matt. It's a pleasure to be here today. I want to thank everyone at Peak Trust Company for hosting this and marketing this webinar. We have an overwhelming number of attendees. It did really nicely, so I want to thank everyone who has taken time out of their busy days to attend this webinar this morning. So this is a very fun topic. We're going to be talking about decanting. So let's go to the first slide. So this is a picture of your client. You can see your client frustrated because your client wants to change his trust, and you have to remind your client that the trust is irrevocable. So traditionally, we have had nothing that we could have done to change an irrevocable trust, and our clients have been stuck with whatever decisions they made when they created their irrevocable trust. That was then, and this is now. Now we have a concept called decanting that is in the statutes in 25 different jurisdictions now. So if you have a trust that is set up under one of the 25 states that allows for decanting by statute, or if you can move your trust to one of the better, more flexible decanting jurisdictions, you can now change the trust. And more often than not, it's the advisor who wants to change the trust. Sometimes the client will want to change it, but more often than not, the advisor will look at the trust, see something that can be improved for the client and the client's family, and then want to change the trust. So going to the next slide, and there's a little delay. Decanting in the context of a bottle of wine is when you pour the liquid from the original bottle into the decanter, and you leave all the bad stuff at the bottom of the original bottle, and you put all the good stuff in the decanter. We can do exactly the same thing with a trust, but you need to understand what it is in the context of wine because it's very similar. And I apologize, I'm having a little delay when I'm moving slides. So I call this a do-over trust. I think from a marketing standpoint, it helps to explain it to the client or prospective client as a do-over. You get another shot to make an adjustment to a trust that you thought was irrevocable, but you can still make the changes. So just as you can decant a bottle of wine by pouring the liquid from the original bottle into the new bottle and leave the bad stuff at the bottom of the original bottle, you can pour the assets from one irrevocable trust into a new irrevocable trust, and you leave all of the unwanted terms at the bottom of the original trust. So we essentially can set up a new trust for the benefit of one or more of the same beneficiaries of the original trust. You can't add beneficiaries. You can set it up for one or more beneficiaries of the original trust. I'm having a little trouble with the slides, so Barbara, could you take the slides over? Because they're not moving when I'm hitting it. Thank you. Okay, so we can set up a new trust to do the decanting, or we can decant into a pre-existing trust. If almost always we're going to set up a new irrevocable trust, simply because when we look at the current trust, we're going to want to make changes that we want today or that our client wants today. We're not going to want to be locked into decanting into a pre-existing trust that might not be exactly the way we want it today. But you can decant either into a new trust or a pre-existing trust. And if it's somebody else's client and you're the attorney, you're always obviously going to be setting up a new trust, because the attorney who now has the client generally believes that his or her trust forms are going to be better than whatever trust form the client already had. So let's go to the next slide, please. Decanting derives from the common law. The common law essentially says that if the trustee has the power to make a distribution outright to one or more beneficiaries of a trust, then why shouldn't that trustee have the power to make a distribution to that beneficiary, but with strings attached? The strings being to make the distribution in trust. That doesn't mean that it's going in trust to handcuff the beneficiary. Very often the distribution is being made in trust where it enhances the controls and the benefits of that beneficiary. So the power to decant can either be provided by the terms of the trust. So you'll see a number of trusts nowadays that actually have decanting language in the document, which means that you can do this under any state law that has has a trust that has the decanting language in it. I personally don't think that's a good idea, because you're opening up the idea in the minds of the trustee, who might also be a beneficiary, that trustee might be able to use decanting to do something that might not be the right thing to do. I personally believe we should not be putting that language in the trust. I think we should, as the advisor, know when and when not to suggest it to a client, as opposed to putting it blatantly in the document so that that trustee gets the wrong idea and cuts people out that shouldn't be cut out, for example. But so generally you're going to be going to one of the decanting jurisdictions, and I told you there are 25 of them now, and you're probably going to want to go to one of the leading jurisdictions, simply because there are more flexible decanting statutes in those jurisdictions. Decanting has been allowed by common law in 4 different cases, and you see them on this slide. And I know that people don't like to hear about boring cases, so I'm not going to go through each case. I want this presentation to be more about planning opportunities for you, not making you feel like you're in law school listening to case law. But what these 4 cases have in common is that the trustee had the power to make a distribution in their absolute discretion outright, and the court approved them making that distribution in trust. This is not a license for you to believe that because there are common law cases where it has been approved, you can just decant a trust without being in one of the decanting jurisdictions or having decanting language in the trust. Common law means that you need to decant it and go to court and petition the court and have the court approve the decanting, so you know that it can be done. So the bottom line on this slide is there are 4 cases. What we see in common is absolute discretion, but you're going to find that there are a lot of decanting jurisdictions that will allow you to decant a trust even when it's not absolute discretion, where it's health, education, maintenance, and support type of language. So let's go to the next slide, please. There are differences from state to state. And Peak Trust Company is now in both Alaska and Nevada. These are 2 of the strongest decanting jurisdictions. You'll find that most of the decanting jurisdictions do not allow you to do just about everything that's on this slide. So let's go through this. Does the state allow you to decant a discretionary trust? There are 25 states that allow you to do that, so that one's simple. Does the state allow you to decant a trust with an ascertainable standard, such as health, education, maintenance, and support? I believe that 23 of the 25 states allow you to decant a so-called health, education, maintenance, and support trust. So you can't decant that one in 2 of those 25 jurisdictions. Does the state allow you to decant a trust with an ascertainable standard into a discretionary trust? This is key, because from a creditor protection standpoint, that would decants it and protect that trust from divorcing spouses, for example. And there are 7 states of the 25 that will allow you to do that. That is one of the most important distinctions in some of the states. You will be hearing me give an example on that later in the session. Does the state require notice to be sent to all beneficiaries? There are 7 states that do not require notice. I call it a private decanting. And what that means is your client won't be stopped by the difficulty in not wanting to send a copy of the current trust and the proposed new trust to the beneficiaries simply because they're private documents. So even if you're already in a state that allows decanting, if it requires notice and your client is not comfortable sending copies of the trust to the beneficiaries, you will want to move it to a state like Nevada that allows you to decant the trust in private because our clients want privacy. Does the state allow you to remove a mandatory income interest? There are 6 states that will allow you to remove a mandatory income interest, and we're going to be going through an example on that later on. Does the state allow the second trust to accelerate a remainder beneficiary's interest? There are 4 states that will let you do that. We have an example that we'll be going through on that. Does the state allow the second trust to give a power of appointment to someone that can be exercised in favor of someone who is not a beneficiary of the first trust? Remember that I told you that you can decant a trust and make a distribution in trust for one or more of the same beneficiaries of the initial trust. You can't add a beneficiary, but in a very clever manner, I'm going to be giving you an example later on in the session so you can see how we can indirectly add a beneficiary by using 2 steps that we couldn't have done with a regular decanting. So let's go to the next slide, please. What happens if there's no decanting statute in the state where the trust is domiciled? Are we stuck? Do we give up? No, we look at this like playing a game of chess. If you were to play a game of chess and think one move ahead, you would lose. When you play chess, you have to think a few moves ahead. How do we get from point A to point Z by taking as many steps as we need to take? So the thought process here is don't give up. We're looking for planning opportunities here so we can help our clients. First step is look in the trust agreement for a change of situs provision. If there's a change of situs provision, then you move the trust to state X, the top or one of the top decanting jurisdictions, and then take a deep breath and go to step 2. Step 2 is you decant the trust under that state's laws. Another thing we can do here is if we're in a state that does have a decanting statute, but it doesn't have a flexible decanting statute, or it requires notice and we didn't want to give notice, or for whatever reason we didn't want to do everything that we would have had to do, or we're not able to do whatever we wanted to do a 2-step decanting. First, decant it under the first state, and you will have to give a copy of the first trust, and maybe the second trust will only have one change, which is a change of situs provision. Take a deep breath, change the situs, or just decant it to the new trust situs, then redecant it, and when you redecant it, you can do everything that you wanted to do, but you were precluded from doing for whatever reason under the first state's decanting statute. Another opportunity here is if there's no decanting statute, look to do a non-judicial settlement agreement to have all the necessary parties agree to change the trust however you want within the bounds of that state statute's non-judicial settlement agreement language. And not every state has it, but you'll have to take a look at whether that particular state has that language. You can make adjustments. Now, it's a lot more limited than what you can do with decanting, but you might be able to change it just enough so that you can then take your deep breath and then decant it. And then finally, if we're all out of ideas, petition the local court for a trust reformation, make some changes, and then slip in a change of situs provision, or petition the court and ask the judge if you can change the situs. change the situs, and then decant it. So what I want to convey on this slide is don't ever give up, look for planning opportunities, and even if there's no decanting statute or it's not as good as you would have wanted, there are ways to get from point A to point Z. Let's go to the next slide, please. Let's look at some common reasons to decant. The first one is extending the term of the trust, and go ahead and click it one more time, Barbara. So the example here is pre-existing irrevocable trust makes mandatory distributions 1/3 at age 25, half of the balance at age 30, and the balance at age 35. This is a so-called staggered distribution trust, and this will look familiar to most of you, and it looks like what roughly 95% of the trusts that I see happen to say. I would almost never do a staggered distribution trust. In the thousands of trusts that my firm has done over the years, there might be one or two of them that were done that way, and they were extremely small estates, and there was some compelling reason, like the client was going to walk out the door if we didn't do it this way, and so we threw the language in. You should almost never have a trust that forces the distributions out at staggered ages, because only bad things happen there. It forces the distributions into the hands of the beneficiaries, and if the beneficiaries ever get sued or go through a divorce, these assets can be taken, whereas if they were kept in the trust and instead we gave the beneficiary control as a trustee upon reaching that age, those assets would have been protected from creditors and divorcing spouses. It also forces the assets into the hands of a beneficiary who might not need the income off of it and who might be in a high income tax bracket. So we lose the opportunity to income shift by making distributions, by sprinkling them to lower tax bracket beneficiaries, such as the children and grandchildren who might not be in the highest income tax bracket that the primary beneficiary might be in. It also forces assets into the hands of a beneficiary who might live in a state that has a high state income tax, whereas if had we kept it in the trust, we might have been able to decant the trust or have certain trustees resign or whatever we have to do, depending on state law, to save or avoid state income taxes. So in other words, we just forced the assets out of a trust that gave us all these great options and put them in the hands of someone so that we were forced into whatever creditor, divorce, and tax issues that that particular person has. It also forces the assets into the hands of a person who might have to give their surviving spouse a certain percentage under a widow's election in a common law jurisdiction, as opposed to keeping it in a trust so it's kept out of their estate and the surviving spouse's widow's election won't be affected. So there's not a lot of good other than saving on an annual tax return. There's not a lot of good in forcing the assets out. So this is the most valuable example that I'm going to give you today. If you only come away with one example, it's this one, because this is probably 3/4 of the decantings that we do for all of the reasons that I just gave you. Let's go to the next slide, please. And go ahead and click it again. Thank you. Changing a support trust into a discretionary trust. This is probably the second most valuable example I'm going to give you. The pre-existing irrevocable trust says that distributions can be made by the trustee for health, education, maintenance, and support. And again, I see this in probably 95% of the trusts that I review that are drafted by attorneys in other law firms. From a creditor protection standpoint, depending upon which state the trust is domiciled in, this could open the trust assets up to certain exception creditors based either on statutes or by judicial creation, depending upon that jurisdiction and how they look at certain classes of creditors. The number one creditor that we need to be most concerned about is divorcing spouses. There are a lot of jurisdictions that either by statute or by case law will open the trust assets up to divorcing spouses. Let me just give you a couple of examples. I'm not trying to pick on certain states, but California by statute will open a so-called HEMS trust up to a divorcing spouse. Delaware is an example that most people would not be aware of or even think this would happen in, but the famous Garrettson v. Garrettson case from 1973 opens a health, education, maintenance, and support trust up under Delaware law to a divorcing spouse. So you're going to want to move the trust to another state like Nevada, where you can decant a support trust into a discretionary trust so that you can protect it from divorcing spouses. And you all know that almost every one of your clients is worried about their descendants going through divorces. So in my opinion, this is the second most valuable decanting opportunity in all of my examples. Let's go to the next slide, please. And click it one more time. Saving state income tax on undistributed income. I've hit this just a little bit, but let's give an example using California. Each state has a different statute that will grab income and force it to be taxed under that state law, depending on the state long-arm statute. So California isn't my example simply because it has the highest state income tax rate of 13.3%. So I do tons of these for California residents for that reason. So under California law, they will tax a non-grantor trust if there are any California non-discretionary beneficiaries and if there are any California fiduciaries. So in my example that you see on your screen, we have a non-grantor trust for the benefit of California beneficiaries for health, education, maintenance, and support. That is not a discretionary trust. That's a non-discretionary trust because it has that standard. So that opens the trust up to state income taxation to the extent income is not distributed. And also, it has a California trustee. So this trust, to the extent it doesn't make distributions to beneficiaries, is going to pay California state income tax on all of the income. So if we have a client with a trust like a credit shelter trust and the client doesn't need the income distributed, there's no good reason to pay 13.3% state income tax on undistributed income. So what we can do is move the trust to a decanting jurisdiction. California is not one of the decanting jurisdictions. And then decant it to get rid of any California fiduciaries and to change it into a discretionary trust, because remember, California discretionary beneficiaries do not open it up to tax. And we have cleansed the trust of the 13.3% state income tax. So for all of the financial planners who are attending today's session, you can imagine your assets under management for your California clients, rather than being decreased by 13.3% tax every year, you now are in partnership with your client and you have a brokerage portfolio that is growing state income tax free inside of this trust. That's a huge opportunity we can solve through decanting. Let's go to the next slide, please. And hit it one more time. Changing the governing law of the trust. So the example here is the pre-existing irrevocable trust is absolutely perfect, except it has a bad state law and doesn't have a change of situs provision. Probably half the trusts that I review have a change of situs provision where they give the trustee or a trust protector the power to change the situs, and the other half do not. For whatever reason, it seems like the trusts that are situs in the worst jurisdictions fail to have the change of situs provision. I don't know why that's the case, but it seems that way. So if there is no change of situs provision and you're in a decanting jurisdiction, we can change the situs by decanting the trust to the other decanting jurisdiction and simply change the situs for whatever reason. It might be a state income tax reason. It might be a divorce protection reason. Remember, a lot of these trust situses will open the trust up to divorcing spouses. For whatever reason, let's change the situs by adding a co-trustee that is located in the better situs jurisdiction. So let's go to the next slide, please. Indirectly adding a beneficiary. I alluded to this earlier on in the session, and this is really good stuff that most people would not think about. As you know, none of the 25 decanting jurisdictions will allow you to add a beneficiary when you are decanting, and that's how it should be. Otherwise, people would be doing a lot of very wrong things. But can we indirectly add a beneficiary even though we can't directly do so? And the answer is very often yes. So the example here is pre-existing irrevocable trust is set up for the spouse and descendants, and it cut out one of the children, and that's because the client said, I haven't spoken to this child in years. I hate this child. It's a bad child. I wish they were never born, and I'm never going to want this particular child to get anything from this trust. And even though as the attorney you might have said, well, just in case, why don't we put them in there and just give them nothing so that we can decant it to increase their share from 0 to something in the future. And you know how clients are when they have their mind made up. They don't want this child in there, so we set it up for the benefit of spouse and all the descendants that specifically cuts out one of the children. So now the client comes back to us and says, you know, I changed my mind. Things are different now. We're on speaking terms, and I want that child to get a full share. And traditionally, your answer would have been, you're out of luck. But what we can do is decant the trust to give the spouse a non-general power of appointment and have the spouse exercise that at death to add in the previously unwanted child so that that child gets a full share. What happens if there's no spouse in the trust? So a lot of these trusts will be just for the client's descendants. It's a little tougher there, but if we use a little creativity, one thing we can do, let's say there's 5 children and 4 of them are beneficiaries and 1 of them was excluded, why don't we decant it to give all 4 of the included children lifetime and testamentary non-general powers of appointment, allowing them to appoint it to or for the benefit of that 5th child that was excluded. And under the philosophy that roughly 99.8% of America would not have a federal estate tax right now if they were to die, most of the time if we have the child exercise their non-general power of appointment now and make gifts from the trust to the previously unwanted sibling, even though there are some gift tax issues involved there, for the most part, most of our clients don't need to worry about that. So we have each of the 4 children exercise their power of appointment, and maybe they appoint a few $100,000 to a trust for the benefit of that 5th child who was excluded. So what I'm giving you here is an example of how if we use our creativity, we can sometimes get somewhere that we previously didn't realize we can get to, and it opens up a lot of opportunities for you, and it opens up a lot of opportunities to move these trusts to the better decanting jurisdictions so you have these opportunities for your clients. Let's go to the next slide, please. Another common reason to decant is to get a step up in income tax basis. So an example here is we have a pre-existing irrevocable trust for the benefit of multiple discretionary beneficiaries, and as I just noted to you, 99.8% of America, if they were to die today, would not have a federal estate tax. Now, obviously, some of them would have state estate taxes, but federally, almost nobody has an estate tax. Obviously, our types of clients tend to be on the wealthier side, so you have to look at the family that is in front of you at that moment. But for the most part, we are in a world where with this $5 million plus inflation, federal estate and gift tax, we have a lot of people that are dying and leaving unused federal estate tax exemption, and you can't take it with you. So one of the opportunities we have here is to give general powers of appointment to the oldest or sickest and poor beneficiary who's a discretionary beneficiary in this trust, and make it exercisable only with the written approval of the independent trustee, who is a non-adverse party, so it's still a general power of appointment, even though the beneficiary isn't going to be able to actually appoint anywhere, because our close friend is going to have to approve the exercise, and they won't if it's being exercised to the wrong person. And by giving them that general power of appointment, which we do by formula so as not to cause any federal or state estate tax, and by formula over the lowest basis assets first that have the best opportunity for a high basis and the best advantages for the family, such as higher tax avoidance being more important than long-term capital gains tax avoidance, for example. By giving them these general powers of appointment, we get a free ride on a basis step up. It's like a form of currency. If you die having not used your full exemption, and by not causing estate inclusion, you're losing an opportunity to give a step up in basis over the low basis assets in the trust. This is something that you can take to your clients, and you might create some opportunities for someone who's going to die, who's sickly or old, and their net worth is $100,000. There might be $5 million plus of assets in this trust that have a basis of zero, like depreciated real estate, where if you give a general power of appointment over roughly $5 million of zero basis assets, you just gave the trust an opportunity to redepreciate the real estate. That is a huge number. So this is something we can do through decanting that might not have been contemplated when the trust was set up. Let's go to the next slide, please. Correcting drafting errors or ambiguous terms. We can almost skip the slide because I know that none of you ever make any errors. You know, I'm perfect too. We all know that is not true. We all make errors. We're all human. So if we see an error or an ambiguous term in a document, such as the example here, attorney accidentally added 2 conflicting provisions in the trust agreement, we can decant it to fix this problem and make it unambiguous so that the trust now makes sense. So that's just something for you to look at, and I hope that you don't have to use this one a lot, but for the situations where you discover that you've made an error or the previous attorney has made an error, it's an opportunity to fix it for the family. Let's go to the next slide, please. Removing a mandatory income distribution. The example here is a pre-existing irrevocable trust has a provision distributing all income to a beneficiary. So I'm not talking about a trust where for tax purposes you need the mandatory income distribution. So this doesn't work for Q-tip trusts or charitable remainder trusts or GRATs where you have to have whatever income distribution was built in. I'm talking about a situation where someone set up an irrevocable trust, like a credit shelter trust or an irrevocable life insurance trust or a $5 million gift trust or whatever it is that says pay all income to the spouse. Well, from a creditor protection standpoint, why would we want to force all the income out to the spouse or to whatever beneficiary is getting the income? What if that beneficiary has a creditor problem? What if that beneficiary has a divorce issue? When you force the income out, you're giving them a vested right to the income, which is an asset that can be taken by a creditor or which can be includable in a divorce. So we want to remove it by decanting so that we have a discretionary trust. If it makes tax sense to distribute all the income because of their lower bracket than the trust, you don't need a mandatory income distribution to do that. You make it discretionary and just distribute all the income. You get to the same spot, but with the flexibility. The other situation where this is important is someone who's in the highest income tax bracket or in a high state income tax bracket as well might want to sprinkle the income to lower bracket beneficiaries, both federally and for state income tax purposes. So we want to decant the trust so that it's now in a discretionary trust, so we can sprinkle to lower income tax bracket beneficiaries, or sometimes retain the income in the trust if the beneficiary and the trust are in the same federal bracket of 39.6% as our highest federal bracket. If there's an opportunity to avoid state income tax, let's not force the income out if the beneficiary doesn't need or want the income. Let's keep it in the trust, draft the trust, or decant the trust to fix any state income tax situations so that we can avoid it, and that way we'll save a lot of money for our client. So let's go to, and there are, I think 6 decanting jurisdictions that will let you do what is on this slide. So most of them will not let you do this. So it's another opportunity to move the trust to a better decanting jurisdiction and then decant it to do what I just went through on this slide. Let's go to the next slide, please. Accelerating a future beneficiary's interest. There are only 4 states that will allow you to decant a trust to do this. So The example here is a pre-existing irrevocable trust doesn't include grandchildren as beneficiaries until the child dies. What if we want to sprinkle income to the grandchildren? What if we want them to have 10 or 20 or 30 or $40,000 of extra income to live off of because they're in their 20s and 30s and struggling, and maybe for no fault of their own lost their job? We want them to get some income from the trust. What if we want to use their lower income tax brackets? This gives us a way to move remainder beneficiaries or future beneficiaries up to become current beneficiaries, so we have more flexibility to do all of the features that I've been suggesting during this session. Let's go to the next slide, please. Changing trustee provisions. The example here is pre-existing irrevocable trust doesn't have a successor trustee named and doesn't give anyone the power to name a successor. So let's say our trustee is 85 years old and we look at the document and it looks like we don't have a succession there, and we're going to have to petition a court at some point if we don't get this cleaned up somehow. We can decant it to add a succession of trustees and or give the grantor or beneficiary the power to add and remove trustees so that we have the right flexibility going forward. Another example here that's not on this slide that I've had to do in a real life decanting a few times is we look at the client's existing irrevocable trust and you say to the client, do you still want John Smith to be your successor trustee? And I've had the client look at me or prospect look at me and say, I didn't realize I had John Smith in there. We used to be best friends and business partners, and we got into a lawsuit against each other 10 years ago, and we don't speak. And good thing we noticed that, because John Smith was the successor trustee, and now if there's no other way to fire and hire to remove them, we can fix the problem by decanting. So what I'm trying to do is give you a lot of different ideas so when you are issue spotting, you're able to find opportunities to decant trusts. Let's go to the next slide, please. Let's take a look at some of the key provisions in Nevada's decanting statute. Peak Trust is now operating in Alaska and Nevada. I'm focusing on Nevada simply because I'm personally in Nevada and I use Nevada's decanting statutes probably at least 99% of the time. I have had to decant in other states as well. Let's go to look at a few of these slides. So let's go to the next slide, please. And what I want to accomplish here is I just want you to take a look at what a decanting statute looks like. So sometimes when you just generically talk about a topic, it doesn't hit home unless you see it with your own eyes. So this is the primary language. You see the underlined part: a trustee with discretion or authority to distribute trust income or principal to or for the benefit of a beneficiary of the trust may exercise such discretion or authority by appointing the property subject to such discretion or authority in favor of a second trust as provided in this section. All it says is if you can make a distribution outright, you can make a distribution in trust. Really simple. Let's go to the next slide, please. And we'll focus again on the underlined portions. The second trust to which a trustee appoints property of the first trust may only have as beneficiaries one or more of the beneficiaries of the original trust. I've said that a couple of times during this session. That is going to be very standard in every state decanting statute. And then A here says to or for whom a distribution of income or principal may be made. Now we're going to need a distribution of principal to be allowed in order to decant the actual corpus of the trust. So you have to make sure that that's allowable in your existing trust. Otherwise there's no power to decant the corpus, because if you can't make a distribution of principal outright, you can't make a distribution of principal or corpus in trust. B here says to or for whom a distribution of income or principal may be made in the future. That's where I gave you that example about moving a remainder beneficiary up to be a current beneficiary. That is reasonably unique in Nevada statute. Not a lot of the decanting statutes have that language. And then at the end of this slide, you see a permissible appointee of a power of appointment exercised by a beneficiary of the second trust is not considered a beneficiary of the second trust. So what that means is, where I gave you that example where we can indirectly add a beneficiary even though decanting does not allow you to add a beneficiary, some of these decanting jurisdictions, I believe it is 14 of the 25, but don't quote me on that, will specifically allow you to do what I just read. The other ones either say you can't or they are silent. If you want to allow that, I would not use a decanting jurisdiction that is silent. Silence doesn't necessarily mean yes. Let's go to the next slide. And then this is just the section that says the trustee may give notice and may petition a court for approval. Most of the jurisdictions, all but 7, require notice and require you to send a copy of the current trust and the proposed new trust and the decanting agreement. So Nevada says may give notice. That's a huge opportunity because most of our clients don't want the beneficiaries to all have a copy of the trust. It's just a privacy thing. It's not about doing things behind their backs. So I just wanted you to see the sample Nevada language, and then let's go to the last slide here, and actually the second to last slide, I think. The trust instrument of the second trust may grant a general or limited power of appointment to one or more of the beneficiaries of the second trust who are beneficiaries of the original trust. The only point I want to make here is you can't give powers of appointment to people who weren't beneficiaries of the first trust, and the beneficiaries can be given both a general or a limited power. General would be to cause estate inclusion. Limited would be just to give flexibility without causing estate inclusion. So I just wanted you to see these flexibilities, and I picked select provisions in our decanting statute here in Nevada. Let's go to the next slide. And I think this is my last slide if I remember correctly. I don't want to get too deep into tax issues here, but I just want to make a few general statements. If we decant a grantor trust into a grantor trust, that is not going to be taxable per Revenue Ruling 85-13, which you're all familiar with because you've all heard that ruling in the context of installment sales to intentionally defective grantor trusts. Same thing. It's like decanting from yourself to yourself, not a taxable event. When you decant from a grantor trust to a non-grantor trust, that's the only one I want to make sure you just take a look at it before you do it. What you need to make sure is there's nothing that would trigger an income tax. For the example here would be an asset that has a debt that is greater than basis. So if a disposition of that asset would normally trigger an income tax, it's not clear. The IRS has not officially ruled on this, but you just need to be careful. And if it would trigger an income tax, just take a look at how important it is to do the decanting versus whatever that tax would be. If that tax is nominal, then go ahead and do the decanting. If the tax is a huge number, unless that decanting is very important, such as decanting to get rid of that successor trustee that you don't speak to, which is, in my opinion, about as important as it can get, unless it's that important, you probably don't want to decant that bad asset. You don't have to decant every asset. So you would decant everything but the asset causing the problem. And then finally, non-grantor trust to grantor trust, that should be non-taxable, so don't worry about that. Final comment on gift tax. Do not require the beneficiaries to agree to the decanting. If they have to agree by signing a piece of paper and they are losing something by doing the decanting, some sort of beneficial access, then you may be causing them to have a taxable gift. I say this, but then the reality of the world in which we live is that 99.8% of America would not have a federal or estate or gift tax if they were to die today. So if someone is giving up a little bit and they sign a piece of paper, my real life answer to this is, so what? You give them some disclosure, but so what? If their net worth is $1, who really cares? Let's go to the next slide, and I think I'm turning it over to Matt to make some announcements here. So I'll turn it back to Matt now.
Yes, Steve, that was a great presentation, and thank you. Today's presentation was sponsored by Peak Trust Company. Those of you who may know, Peak Trust Company was formerly Alaska Trust Company, which was established in 1997. The company chose to expand outside of Alaska for a variety of reasons, client demand, and also to offer choice of situs. It kind of goes with the theme that Alaska Trust Company, now Peak Trust Company, has had since inception to offer unbundled, flexible solutions and options. This gives us the ability to work with clients inside and outside the U.S. We have a lot of experience on our team. I think you'll find working with our team is on par with the best in the industry. And we'd also like to remind you that Peak Trust Company is putting on a workshop in Las Vegas later this year. We have a great panel of speakers, as you'll see here. Feel free to go to peaktrust.com/events to register. If you have any questions or difficulties registering, please feel free to email myself and we'll get that worked out. Again, thank you for attending. Here's some contact information for not only Steve, but Peak Trust Company. And let us know if you have any questions, comments, concerns, or feedback. And for now, we'll move on to questions. First couple questions we have here, Steve. Do you have to give notice to the beneficiaries to decant a trust?
Okay, now I assume that question probably came in early on in the session. In 7 of the jurisdictions, you do not need to give notice. In the other 18, you do need to give notice, and I don't know that I've read that closely every one of the statutes, but I believe that they probably all require a copy of the current trust, the proposed decanting trust, and also the decanting agreement, and you need to give it to whoever they define as qualified beneficiaries based on that state statute. So if notice is not a problem and you can decant and do everything you want in that jurisdiction, then great, decant under that jurisdiction's law. If the client doesn't want to have to give copies of the trusts, then move the trust to a state like Nevada where you don't have to give notice, and then you can privately decant the trust. Great question, though. Thank you for that question.
The next question we have, are there any particular issues to watch out for other than the obvious when decanting a trust that owns life insurance and thus changing the ownership of such life insurance?
Sure, and I see a lot of life insurance trusts being decanted, and we decant a lot of them. There shouldn't be any problems there. All you're doing is making sure that the life insurance agent follows through with the change of owner and beneficiary to the new decanted trust. The decanted trust is treated as an extension of the original trust, but still you're going to be retitling it in the name of the new decanted trust. And this is not life insurance specific, but one of the errors that I do sometimes see people make in decanting is they're a little loose in not being sure that there isn't inadvertently at least one extra beneficiary added into the new trust. So make sure you really carefully make sure there's no additional beneficiary added, and sometimes your decanting agreement might be best drafted with a provision that says, notwithstanding anything in the new trust, any additional beneficiary shall be void, and that might be your savings clause. I know that's not life insurance specific to this question, but it's just changing the owner and beneficiary. It's just like any asset, like a widget.
Understood. Thank you. One question is, who goes about requesting the decanting? Is that the grantor, the trustee? Which involved parties request the decanting, and how do we go about that?
Sure, anybody can request the decanting. The party that has the power to make the decanting is the trustee, who has the power to make a distribution. So sometimes the decanting is indirectly requested by the estate planner, who discovers something that can be either fixed or enhanced, who then requests that the trustee cooperate to do the decanting. But that can come from the grantor, it can come from a beneficiary. It basically comes from whoever happened to be sitting in front of the estate planner when they decided to do the decanting. So the official request can come from anyone. The trustee who has the decanting powers is the one that effectuates the decanting.
Okay. We have time for a couple more. What implications are there related to a grandfathered GST trust? Do you see decanting causing any issues?
Okay, and this doesn't come up for me a lot. I think it comes up about once a year for me, so excuse me not having it on the tip of my tongue here, but there are either 2 or 3 different things you need to look for, or ways that you can decant a grandfathered trust. It comes right out of the Treasury regulations. So you have to. So whenever we decant a grandfathered trust, we always pull out those same Treasury regulations and make sure we fall under one of them. So just follow the Treasury regulations and make sure that that you are doing so. Otherwise, you can have some tax issues there.
Thank you. Steve, do you believe that a decanted trust should get a new TIN from the original trust? Tax ID?
Yeah, that's a great question. These are great questions. I want to thank everyone for the great questions. We usually will get a new taxpayer ID number for a trust, but if we do what I call our short form decantings, which is where we just do about a 2-page decanting where we incorporate by reference the entire same trust document, like I did that for my own irrevocable trust, for example, a couple years ago. When we do that, we don't get a new tax ID number and we don't retitle the assets. If we're going to be going into a full trust, we get a new TIN number. But if you're just going to do something that's more short and you're going to cut a few corners just because it would be silly to not do so, there's nothing that says that you have to get a new taxpayer ID number.
Okay. Could you provide a rough example of maybe the time and, if you feel comfortable, the cost that might be involved to do a simple decanting?
Sure. I love when that sounds like when a client asks you to do a simple will. The word simple is to influence the cost. I'm just kidding there. The time depends on how elaborate it is. I almost hate to give costs. That always gets you in trouble. But when we're decanting someone else's document, when it's not our current client, we generally will charge $10,000 to decant one trust. And that's only because we're treating it like we're going into our best trust, you know, let's call it our dynasty trust, and that's what we would charge for a simple gift into a dynasty trust. So we bill it the same way. If we're decanting our current client's trust where we did the work, they've already paid us a lot of money as our client, I feel that that's an obscene amount of money to charge them, and we will generally just bill hourly because it's generally more patchwork that we're doing, and therefore it becomes more like a let's call it a $3,000 type of hourly charge. I think most attorneys are billing them hourly, and I think they're underbilling. We do that when it's our own client because we feel like they're already part of the family, and I think that's the fairest. But if someone comes in off the streets and they didn't go to us in the first place, we need to bill them like they're coming in and doing a new trust, and we just throw in the decanting document at no charge. So hopefully that wasn't too much or too little to that question, but that's a great question.
Good. Looks like we have time for maybe 2 more. Steve, can you talk about any issues you've seen with the IRS between kind of switching from you know, the original trust to the decanted trust, especially if you've had a change of tax ID numbers?
You're not going to love this answer because I'm not really saying anything here, but we've never had any issue with the IRS, so I can't answer that question. Everything's been 100% clean and simple, and there's really nothing for them to question. I suppose where that will one day come up would be if we have that situation with the negative basis type of asset that I went through on my last slide. Maybe one day we're going to see that, but there's really nothing for them to question here. It's a smooth transition. You're just moving assets to a new trust, and I've never had the IRS even audit one. So the answer is don't be as worried as that question may make you sound.
Great. Well, Steve, we sincerely appreciate your time and the great presentation. For all attendees still listening, please remember we will be sending out a recording and providing the slides to everyone. Thank you for your attendance. We look forward to seeing you soon, hopefully at the workshop coming up September 29th at the Four Seasons Hotel in Las Vegas. Thank you again.